Okay, welcome back, traders. John Caruso here with your futures forecast for the week of October 3rd. Taking a look back at some of the events from this previous week, we did see the S&P finish down 3% on the week, taking its crash lows to down 25% year to date. The NASDAQ was down 3% as well, taking its year-to-date losses to minus 33%. It wasn't much better across the pond either. We did see the UK, we did see the FTSE 100 down 2.5%. France finished down 1.75% on the week, and Germany was also down 2.5% on the week. We did see a lot of trading action in the currency markets. The U.S. dollar Sunday evening spiked to 114.78, ended up finishing down about 1% on the week. The British pound crashed on Sunday evening to down 4.5% to start out the week, but actually finished up 3% on the charts come Friday. So we're going to have more on that later. Gold was up 0.86%. Oil was up 1.14%. And copper prices were up 1.5%. However, copper remains in crash mode at down 22% on the year. So we're going to rewind back to last Sunday and some of the events that took place in the currency markets. The British pound collapsed 4.5%. To its lowest level since 1985 to 103.92. Some of the events leading up to that was the UK announced another round of tax cuts as well as some plans for additional borrowing and spending. Now, obviously, we're in a position right now globally where central banks and governments are supposed to be acting responsibly in terms of monetary policy, and traders absolutely punished the British pound after that announcement. The US dollar shot up to 114.78, finished down 1% on the week. So when I actually see the trading action that we saw inside of the currencies, the British pound fell to 103.92, finished up 3% on the week. So when you're looking for a bottom in a market, we potentially may have seen that just take place in the British pound. When you see that sharp plunge lower, market finishes up 3% on the week. I still think you can position bearishly and trade the British pound from the short side. However, I'm going to be keeping an eye on that 103.92 level as the potential cycle low for that currency. So then obviously going from Tuesday into Wednesday, we heard a surprise announcement by the Bank of England where they were going to be relaunching quantitative easing for another 30 days, which was a complete shock. Obviously, there's something inside the BOE, something was happening inside of their financial system that was scaring the BOE. I think it might have been in the UK gilts. That's their bond market over there. We did see the 10-year gilt shoot up in a short period of time up to 4.5%. We saw the 30-year gilt spike to 5% over there. And the Fed, the Bank of England, I think, was worried about liquidity issues inside their bond market, decided to provide some more liquidity for the next 30 days. And we're going to know more about that as the next month drags on. But that was a very shocking move by the Bank of England. And it kind of begs the question as to whether or not you're going to see more central banks around the globe actually have to temporarily restart QE. All the while they are still raising interest rates. So it's going to get very, very interesting going forward. Here in the United States, the U.S. 10-year actually spiked to 4%, fell back to 370 on the announcement by the BOE, ended up finishing out the week up 2 basis points at 380. We did hear from James Bullard and Loretta Mester this past week, obviously voting members of the Federal Reserve. Both were very, very hawkish. Bullard has been the most hawkish member of the Fed and has been pretty much dictating forward monetary policy or interest rate policy going forward. But Loretta Mester said something that really kind of stuck with me throughout the week. Rubbed me the wrong way, clearly rubbed the market the wrong way. But she said not even a recession will keep the Fed from raising rates and accomplishing the rate hike goals. So very, very interesting to hear that. Very, very hawkish. And of course, in the market, it was straight down from there. The market did not like to hear that. And then on Friday, we saw the PCE index. Okay, the PCE index is the Fed's favorite inflation gauge. Okay, the previous reading was 4.60%. And it's not a surprise that that's where the Fed has the Fed funds rates moving to 4.60% out in the early part of 2023. Now we get a reading on Friday of 4.90% on core PCE. So you've got to start asking yourself, is the Fed ready to adjust policy to even more hawkish from here? I'm not so sure. I think what happened in the BOE, I think that is something that could be contagious by other central banks. I don't know that yet. We're going to know more as the next 30 days moves on. But one thing that you also want to keep an eye on coming into this week is the Credit Suisse 5-year credit default swaps are now trading at levels not seen since 2008 and the great financial crisis. So Credit Suisse, there could be some liquidity problems going on in credit with Credit Suisse, and I've heard some rumors of another bank that could potentially be in trouble over in Europe as well. So we're going to be keeping an eye on that. That's going to be very, very important going forward. At the end of this week, we have the unemployment data, the September labor report due out. We're looking for 250,000 in jobs created in the month of September. We're looking for the unemployment rate to hold steady at 3.7%. We know the Fed right now has a quiet mandate to lift the unemployment rate. Yes, I'm sorry to report that, but they want to see higher unemployment to help tame this inflation beast that we're experiencing here in the United States. So the Fed right now, they think that by the time they're done with interest rate hikes, the unemployment rate's likely going to tick to 4.1%. I'm not so optimistic. I'm thinking based on the rate of change they're raising interest rates and how aggressive this path is, I'm thinking more like 4.5% to probably 5% on the unemployment rate before this is all said and done. So we're going to be looking forward to the labor report at the end of this week. As always, best of luck to everybody out there. I look forward to bringing you more videos like this in the future. We'll catch you back here next time.